What if I told you that in order for you to become a profitable trader, all you would need to spend in front of the markets is roughly 1 hour every single day? I'm talking 5 hours a week, which is less than what an average normal day person spends a whole entire day at their full-time job. And you're probably wondering, how is this strategy capable of doing that and much more? And is it even true? Well, the truth is that it is literally written in stone in order for you to follow and execute this strategy with no failure on your end. It is extremely unlikely that the strategy fails you, but you could fail the strategy. Now, you're probably wondering, how is this even possible for you to fail the strategy? Well, it's very simple, because the whole entire strategy is consisted of a checklist. A literal checklist that you need to check off every single thing before you take a trade. Over the last 6 years, I've gathered pretty much every single move in the market, and I have put them all on a document, minimizing the risk as much as I possibly can when executing every single trade by doing a series of confluences. So when you go execute a trade, you know exactly what confluence you're going to be taking and what is the percentage behind that confluence. So instead of me failing the markets by reading something that I shouldn't, I'm literally following a system that has statistics behind it. So whenever I lose a trade, it's because it simply did not play out according to the statistics, rather than me just executing a trade because I assume what the market's gonna do. And I ended up building the perfect checklist, which literally tells you what to do before entering a trade. Because you won't even have to think when entering a trade. All you literally have to do is just follow the step-by-step plan. Now, this is all great because your win rate will go up roughly around 65 to 70%, but very big but is that it is a double-edged sword, meaning you will win more times, but your risk to reward will be minimized. You'll probably have a 1-to-1, 1-to-1.5. Now, just because you're winning more time doesn't mean you're gonna win more money. The perfect analogy that I can put to this is, let's say you're a fisherman and you're gonna go out there to fish every single day for about an hour, and you can only go so far into the deep ocean if you only have an hour to spend every single day, and you're just able to catch small fish every single day. Now, you're catching more fish, but you're catching smaller fish. Rather, somebody that has all day to go out there and fish, they can go out deeper into the ocean where there's bigger fish. They might not catch a fish every single day, but when they do catch one, they're gonna catch a very large fish, which one big fish can engulf the amount of food or the amount of meat that comes out of it compared to a bunch of little fish that you would catch every single day fishing for 1 hour. So just because you're trading more doesn't mean you're going to make more. Just want to make that very clear. And you're probably wondering, why am I going to teach you something that is not going to make you large sums of money? Well, because I would much rather you get involved into trading, giving it an hour every single day. So you get involved, you start gaining experience, you learn from your losses, you control your emotions, you learn and develop as a trader, so then you can dive deeper and learn how to actually scale and continue to grow. This is a way of you getting your feet wet with the market, with a strategy that will be effective and will work, and you're not trading blindly in the markets and simply wasting your time and potentially getting frustrated and even quitting trading. I was there a couple of years ago, and I know if I would have had a strategy like this, it would have made me scale my trading a lot faster and having a much more deep understanding of why I'm entering a trade, rather than just almost being a gut feeling. And the goal here is not to make a shit ton of money in a single hour or a single day. The goal here is to become profitable, and at the end of the month, have a positive P&L, whether that be 2, 3, 4, 5, 6%. You're profitable. You're ahead of 99% of the industry. And by simply being positive 2, 3, 4%, you're able to execute that on larger sums of money, and then you can simply make a living off of trading. So with that being said, let's get right into it with the first confluence that this trade checklist needs to be checked off. So this is my trading confluence checklist. If you notice, there's a lot of things that I have hidden and I have removed simply because it's so much context to be giving right now. And that's for more of my advanced strategy, where I actually dive deeper into trading. That's for more of taking 1 or 2 trades a week. This is about taking a trade 1 hour every single day, and my same confluences can be used on the lower time frames, and that's exactly what I'm going to be teaching you guys right now. So the first confluence is going to be the trend, and we're going to be looking for the trend on the 4 hour and on the 2 hour. So we have the trend on the 4 hour and we have the trend on the 1 hour. This is going to be a 5% towards our grade. If we simply don't have it, then that will be minimized to then 0. So we want to make sure when we're analyzing the markets that we have these time frames together in order for us to have a much stronger trade. Already considering the fact that we're looking for a trade every single day. And the very, very, very key thing is going to be when. And the only time you're going to implement this trading checklist and these confluences are going to be pre-London session or pre-New York session. You always want to consider entering the market and looking to execute a trade in these two sessions: before it, during it, and that is it. Never after New York session, because it simply will not have any volume. So you can take the trade pre-London, during London, pre-New York, during New York. 9 a.m. is the latest time. And the answer, and you're probably wondering why, the answer is because since we're aiming for these smaller time frame trades, we want to make sure that the session has enough volume to take our trade to the take profit. So for example, perfect example of something we could be looking for would be something like this. This would be a trade that here on the 4-hour time frame, very clearly this is going to the downside. Here we have lower high, lower low, lower high, lower low, lower high, lower low, lower high. So this trade is very clearly heading to the downside. So we'd come over here to our trade checklist and we would count that as then bearish. So that will be 5% towards our grade. Then we're gonna go to the 1 hour. And on the 1 hour, we're gonna do the exact same thing. So we're gonna be looking at the 1 hour at this point right here, which is where I would have entered this trade. When we head over here to the 1 hour, we can very clearly tell that the 1 hour is also bearish. Lower high, lower low, lower high, lower low, and this time frame is then bearish. Cool. So now we have 2 time frames in sync, giving us a total of 10% at this moment. All right, I'll just remove all this for now, just so we can kind of go through it, right? Next, after we understand the trend of the market, we're then going to go to the area of interest. Now, the area of interest is extremely key when taking the trade with this type of strategy, because you need to be at the area of interest. And I know sometimes we wait for trades to get to the area of interest, which could take a couple of hours and can even take a couple of days. With this strategy is going to be literally at the area of interest. Once we're there, we're good to then enter the trade. This is a perfect example how we would spot an area of interest on the 1 hour or the 4 hour. An area of interest, we want to make sure that has a minimum of 3 touches above or below. And this is going to give you the minimum amount of confluences that you would need in order to execute this trade. And on this example right here, you can tell that we have a very, very, very clean level of support. We have 1 tap, 2 taps, 3 taps, 4 taps. So when I see this market break under, and that is then going to retest this area, that is a solid confirmation. So then I would go to my trade checklist, and then I would add that it is at a area of interest as a 5%. Now, if you were to be using the daily time frame or the weekly time frame, which is a specific way on how to use that, and I use that for my personal strategy when I take my bigger trades, that confluence and that percentage would obviously go up. But since we're using the lower time frames, obviously the percentage would be going down, since it's not as respected as the higher time frames. So the area of interest is extremely key that we are at it. If we are not at the area of interest, we cannot take the trade. We have to wait for the market to get to that area. And this is why I analyze 10 to 15 different markets every single Sunday with my students, because I want to make sure that I can define if a trade is at an area of interest or if it's on its way to the area of interest. Sometimes it could take an hour, sometimes it could take a couple of days. This one right here, for example, took about 4 hours to make it back into the area of interest, which is a perfect trade setup for this example right here. So then we would go down to the 1 hour and we would confirm that on the 1 hour, this is as well as a solid area of interest. Here on the 1 hour, we have 1, 2, 3, 4, 5, 6, 7, 8, 9. So this is another confirmation that we also have this area that is respected on the 1 hour time frame. You'll be surprised how many times you'll have a solid area of interest on the 4 hour, but then on the 1 hour, it's nowhere near as respected. Or you have a solid area of interest on the weekly, but then on the daily, it's non-existent. The market just breaks through it all the time. There's a lot of wicks on the weekly, which is all that structure on the daily. Same exact thing applies on these lower time frames. So the area of interest is extremely key, because then this is going to lead you to the next point. If we are not at an area of interest, we cannot take the trade. And the next confluence is then going to be a candlestick rejection from this area of interest. The candlestick rejection is the confirmation that we are rejecting the area of interest. If we're at the area of interest and we're not showing any signs of a rejection, why would we want to take the trade? That simply makes no sense. This is extremely high risk, and already trading on the lower time frames is high risk as it is. So we want to make sure that once we are at this area of interest, that we are actually rejecting it, and that we're having the area of interest and the candlesticks be the exact same time frame. Because if we have a 4-hour area of interest, but the 30-minute is rejecting, but then you go to the 4-hour and the 4-hour still has a bullish candle, there's no real confirmation there. If you notice here, the 4-hour is indeed bearish. We're indeed at this 4-hour area of interest, and then the 4-hour time frame has a double doji rejection from this area, making this a confirmation from this area. So that would be one of the confluences that I would add to my checklist here, which is going to give it a total of a 10%, because it is literally letting us know that it is rejecting this area. Without any confirmation of a rejection, I am not interested in entering the trade. I want the market to show me their hand first. I don't want to take a trade off of speculation that it's going to potentially reject. No. I want the market to reject. Once the market rejects, then that is the perfect indication that not only is my analysis correct, but my confluences indeed are perfectly lining up together, and this trade is now going to have a move. You want to make sure that you can put as many things together when you're going to go enter a trade, so you have a reason to take a risk behind it. And the best analogy that I can use for this is, let's say every single time you're going to go take a trade, you're going to go present it to your cousin, to your grandpa, to your grandma that know absolutely nothing of trading. And if after you show them a series of confluence and you explain to them and they're like, you know what, that makes sense, here's $100, put it there. If they cannot believe in you and your explanation does not make sense to them, don't take the trade makes no sense. This right here, just by me breaking down these first 3 confluences, I'm sure you already are like, that trade does look clean. That is the vibe that you want to get when you're gonna go enter a trade. Everything needs to perfectly intertwine and connect with one another. If not, the trade simply doesn't make sense. So we have a confirmation that we are rejecting from the 4-hour and the area of interest, because we're at the area of interest. Now let's go down to the 1-hour and let's see if the 1-hour is doing the exact same thing. Now here on the 1-hour, you can very clearly see that when this area broke this area for the first time, it had a very strong rejection from this area, giving it a very strong bearish engulfing candlestick from this area. Then price made it back into this area of interest, and then you can see that the 1-hour is having dojis, a bearish engulfing here, a bearish engulfing here. So on the 1-hour time frame, there is additional rejections from this area, which this is, again, an added confluence, because you can have an area break on the 4-hour, and the 4-hour could have massive rejections, but then the 1-hour, the structure is bullish and it's heading to the upside. It doesn't make sense. This right here is a perfect example of it being bearish and additionally rejecting from this area. This is what I call a Picasso perfect trade. So this is where we would add then as well as a 10%, because we're having another confirmation from a different time frame that we are also rejecting this area in confluence with the last time frame, which is perfect, because this is leading for us to then go to our next spot, which is then going to be the entry signal. And that without an entry signal, I am not taking a trade. This is going to be a key fundamental confluence in order for the trade to have the proper entry signal and the proper stop loss and proper take profit. Now, there's multiple steps to my entry signal. This one right here in specific is a bit complex to explain on this type of strategy, and I'm sure I do this in other videos, but this is a very simple entry signal which I like to use regardless of the type of trade that you're taking, and is going to be a bearish engulfing candlestick or a doji rejection. And that can consist of a candlestick like this one right here. You have an evening star formation or any of these doji candlesticks. Now, the entry signal is going to be on either the 1-hour time frame or the 30-minute time frame. This is going to be very key to making sure that you have a sniper entry so your risk to reward makes sense. So in the event of the 1-hour time frame, I would use this 1-hour bearish engulfing candlestick right there. In the event of the 30-minute time frame, we would be using a very clean engulfing from this area right around here. So I would use this engulfing from right here, or I would use this engulfing from right here. This is going to be a perfect entry signal from this spot right here. And then our stop loss, we want to make sure that we can give it anywhere from 10 to 15 pips from the previous high. So if you notice, the 30-minute time frame is bearish up into this area of interest. This is the lower high, this is the lower low. This is creating bearish rejection in here. So this is the high of this retracement, which is a perfect confluence. So we would want to give it anywhere from 10 to 15 pips. So if this is 20 pips right here, we want to make it roughly around 30. And that is a beautiful breathing room for this trade, so you can have the confluence of continue to hold it forever long it is. Because if this market for whatever reason decides to then break above this high, if it breaks above this high, it's very likely that it'll come back into this area, retest it, and then head to the upside. The reason why I give it 10 to 15 pips of breathing room is to avoid liquidity grabs and fake outs. I know we've all experienced this in the market when the market decides to do something like that. For no reason, it'll have a wick and then it'll take you out. Usually these liquidity grabs, these wick outs, tend to just break above these highs, take out the highs, and then continue to have the push. So the way I have perfected, or tried my best to perfect, to avoid this is by simply having a stop loss that has anywhere from 10 to 15 pips above the high, because it's very unlikely, where we are right now, for it to go anywhere above 10 to 15 pips from the high. Is there times where it does it perfectly? Yes, it's inevitable. There's nothing you can do about it. It's part of the process. It's part of the game. I like to call it the fee of trading. The market's gonna, if you're gonna have the opportunity to capitalize off of it, you have to have the other side where you're gonna potentially lose it. It's normal and it's literally unavoidable. But giving it 10 to 15 pips from the high is very key, because then you have that breathing room. A lot of traders, they like to keep it very tight, because I get it, you can have a great risk to reward. We're very, very, very prone to this, and many traders tend to lose trades, not because they're wrong, but just because their stop loss placement is way too tight. So I would have it right around here, around 30 pips roughly. And then my take profit would be set at a minimum of a 1 to 1.5, max 1 to 2 with these type of trades. And this one got to the whole entire 1 to 2. Now, the reason why these trades would be at a 1 to 1.5, max at a 1 to 2, and not my typical 1 to 3, 1 to 4, is simply because you're trading the session. You don't anticipate for the movement that you're going to be taking with the session for it to continue going throughout the next session without having a retracement. So this retracement, let's say it would have gone into New York session, it could have easily come back, created another confirmation, and then had the move, and then here potentially you would have gotten taken out with a liquidity grab. It is very key that you aim to exit your trade at the end of New York session if you entered in London. And if you're decently into profit and you can see that there can be continuation with the daily momentum, then maybe continue to hold, but I would just minimize your risk by going to break even. I would not hold throughout the daily candlestick closure because of spread, and because you can be taken out to your stop loss because you're trading very small trades. If you're not in enough profit, I would simply just close the trade out. Even if you're in a little bit of drawdown or even a little bit of profit, I would just get out. This is a very quick and aggressive type of trading because you're trading with just the session and the volume. So having all of these confluences added up with this trade would give us a total of a 50%. Now, that's not a great type of grade, to be honest. I would give this anywhere from a D setup max, because the type of trades that I like to take are anywhere from 80, 90 to 100%. Now, it doesn't mean it's gonna have a 100% win rate. It just means I have 100% of confluences of things that I can combine together that make the trade have a very high probability of going in one direction versus the other. Now, I've had trades that have 150% and they still end up losing. You're gonna always be prone to exposure in the markets. You're never gonna have a 100% win rate. But what this confluence sheet does, it lets you know exactly what you're looking at, what time frame you should be looking at, and what type of trade you're looking at and what type of grade. Sometimes when you're gonna go enter a trade, it simply doesn't have this, it won't have this, and it won't have this. And you're like, wow, this trade literally only has 30% towards your direction. Does it even make sense to risk 2% of my funded account here when I'm a little bit into drawdown or I've made some nice profit? Does it make sense? Probably not. Or if you're flipping an account and you're on a nice winning streak and you want to enter another trade hop, does it make sense to risk all the money you just made on a trade that doesn't really make sense? Probably not. So you're gonna wait and build up this confluence for the next best trade. And now the very key and important thing when it comes to executing this Confluence sheet is going to be that you look at the right markets. You want to make sure that you have at least the 4 hour and the 1 hour in your direction and that you're at an area of interest. If you have these two things in your favor, you are already ahead of the game because you have the trend in your direction and you're at a solid area where the market has a probability of rejecting there compared to now. Now, all you have to do is wait for that entry signal at the right session, meaning pre-London, during London, pre-New York, or maybe at New York session, so you can then enter the trade and have a quick 1-to-1 or 1-to-1.5. This is all going to be with you simply spending 1 hour a day in front of the markets. And this is cool because you get to get your feet wet, you get to get understanding of how to actually execute a strategy that has statistic behind it and you have confluences in your favor. But where things really get powerful is when you use my actual Confluence sheet, which I can share with you guys if you guys just simply fill out the type form down below. I'll leave a link in the description, where it is this whole entire checklist combined and unlocking different confluences that I personally look at when executing the market, because these other confluences that I have here not applicable at this very moment, they're far more powerful than you can imagine, because it's not only adding these extra confluences, but you're also doing it in combination with different time frames. When they all intertwine, it makes a trade have a much more predictable prediction of where it can potentially go. So for example, if we were to just simply add the weekly time from here and then the daily time from here, without even unlocking these other different confluences that I use, this trade could have easily gone from a 30% to an 80%, even a 90%, giving you more of a reason to enter this trade. So if you guys want to get access to my actual Confluence sheet, I'll leave a link in the description below so you guys fill it out. Once you guys fill out that form, I'll then share it with you guys. You guys will talk to my team and we'll break it down exactly how this can work and you guys can get access to my strategy. And if you're new to my channel, make sure you watch some of my other videos, because there I break down my strategy as well when it comes to using the higher time frames and how to be a bit more patient and have a much greater risk to reward. Hope you guys enjoyed this video. See you guys in the next one.